Hello friends, in this video let us see how to compute income from capital gains. The computation of income from capital gains is nothing but the difference between the sale consideration and the cost of acquisition. Now section 48 of the Income Tax Act tells you how to compute income from capital gains. According to this section, the taxable capital gains would be sale consideration, that is sale that you're going to sale price that you're going to get as per the transaction deed, less any direct expenses which are incurred only in connection with the transfer. Now, for example, any brokerage commission etc. is paid to our broker for the transfer. Now that is taken as a direct expenditure, and this direct expenditure can be reduced from the sale consideration. From the resultant figure, reduce the actual cost of acquisition of the asset, and also in case any improvements have been made to the asset, such an expenditure relating to the improvement is also reduced, and the net figure, that is consideration less direct expenses less cost of acquisition and cost of improvement if any, so the balance figure would be the taxable capital gains. Now when I said cost, okay, this is the actual cost of acquisition that is incurred by the seller of the asset. Now there are some certain special circumstances, special assets, like say a sweat equity. Now what is a sweat equity? This is an equity issued by a company to its employee for any special work done by the employee. To give you an example, suppose a company has got a patent in respect of any product, and its R&D department has worked exclusively to get this patent. So in order to reward this R&D team, if the company has issued certain equities, that is called as sweat equity, and generally this sweat equity will be issued to the employees at no cost. Employees will be getting it free of cost. So if later on, if the employees sell such equities, what would be the cost? Will it be nil? No, because when sweat equity is issued, it is treated as a perquisite in the hands of the employees and taxed accordingly. So whatever the value which is being treated as perquisite in the hands of the employees will be taken as a cost of acquisition of such assets, such security in the hands of the employees when they sell those equity shares. Then there are employee stock option plan. Generally, this is a plan under which equity or shares are issued to the employees by the company, primarily for the purpose of retaining the employees for a certain duration, certain period. That's, for example, employees stay with the company for 3 years, 5 years, then they may be issued some shares. Now how this is done is that generally in such cases shares are issued at a discounted price. Suppose market value is 100 rupees, say the shares are issued at 60 rupees. Now in such a case, when shares are issued at a discounted price, at the time of allotment of shares, it will be treated as perquisite in the hands of the employees and taxed. Later on, when they sell these securities, the cost would be fair market value that was at the time of allotment that was prevalent. Okay. Now, as I said earlier, suppose 100 rupee shares, that is fair market value of the shares was 100 rupees, but it was issued at 60 rupees. So 40 rupees will be taxed as perquisite, and later suppose the employees sell these shares for say 120 rupees. The capital gains would be 120 rupees is the consideration less the cost, that is the fair market value, that is 100 rupees. So 20 rupees would be taxed as income from capital gains. Then there may be cases like gifts or any asset is received under will, inheritance, etc. So in such cases, what would be the cost? So the law says that it is a cost to the previous owner that has to be taken as a cost of acquisition. For example, I have received a building as a gift from my father. Okay. So in my hands, strictly speaking, cost is nil. But when I am working out the capital gains in my hands, the consideration reduced by cost which my father has incurred to acquire the asset, that will be treated as my cost of acquisition. For example, my father also has received it as a gift from his father, and my father has not incurred any expenditure to acquire the asset. Then what happens? Then in that case, I should see cost to my grandfather who has actually acquired the asset. So capital gains would be computed in my hands by taking the sale consideration for which I have sold the building as reduced by the cost which my grandfather has incurred to acquire the asset. That will be the capital gain in my hands. But when assets are acquired long back due to cost of inflation, value at which the asset was acquired gets reduced drastically. That is why this concept of indexed cost has come in now. Now, this index cost would be applicable only in the case of long-term capital assets. That is, when I get only a long-term capital gain. And again, this would not be applicable to sale of securities, other than securities, like land, building, jewelry, any other asset. Now, indexed cost is actually based on cost of inflation index declared by the government. Every year, somewhere around August, July, August, government comes out with the rates of inflation rate and cost of inflation index. So there is a table. So based on that, we have to work out the cost. For the working out of this index cost, the base year was earlier 1981. Now this has been shifted to year 2001. If an asset is acquired prior to 1/4/2001, then value as on 1/4/2001 will be taken as the cost. Normally this is with reference to the financial year. Suppose I have purchased a property, say somewhere in 80s. So today its value would look very nominal. Therefore, to give some benefit to the taxpayer, indexed cost has come into the picture. So if any property is purchased prior to 1/4/2001, fair market value as on 1/4/2001 will be treated as its cost. This is called as the base price. Okay. Now, in case any asset is acquired later, we have to look into the index table, and what indexed rate as announced by the department will be taken as the cost of acquisition. Now, to give an example, suppose a property is purchased on 1st July 2004 for say 30 lakh rupees, and this property is sold on 1st August 2020 for 120 lakh rupees. Then looking at cost of inflation index table, we can see that the index rate for the financial year 2001-2 is 100, and 2004-5, that is in this case the year in which the property was purchased, the rate is 113 in the table, and the current year, that is the year in which the property is sold, is 301. Then how do I work out the indexed cost? Okay. It is 113, that is in 2004-5 index cost was 113. So cost was 113 as against actual cost was 30 lakhs. So what would be the cost today? It is 301. So 30 multiplied by 301 and divided by 113, that is 79.91 lakhs would be treated as the cost of acquisition. And capital gains would be 120 lakhs minus 79.91 lakhs, that's 40.09 lakhs. Friends, here, look at this. Suppose index cost of acquisition was not there. If I simply take the cost of acquisition, the cost will be only 30 lakhs and capital gains would be 90 lakhs. Okay. So to help the taxpayers, this concept has come in. To give another example, if the property was acquired before 2001, say in the year 1994, if the property was purchased in 1994 for 30 lakhs and it is sold for 120 lakhs in August 2020, let's look at the inflation rates, inflation index. 2001-2, that is the base year, is 100, and 2021 it's 301. So now the cost of acquisition would be 30 multiplied by 301 divided by 100. Because why 100? Property was purchased prior to 1/4/2001, so I have to take the cost as the base year, that is 100. So here the cost of acquisition would work out to 90.30 lakhs. So capital gains would be 120 lakhs minus 90.30 lakhs, that's 29.70 lakhs. Yes, friends, then let's move on to the meaning of the term consideration. Now, what is this consideration? This is the sale price as per the transfer deed, either actually received or accrued. Now, what is the meaning of this term accrued? That is, when I enter into this transfer deed, a quantity of consideration is fixed, but then they said that I received this sale consideration after say 6 months. So today I will not get any consideration. But for capital gains, the actual receipt of consideration is immaterial. Okay, so whether I receive it today or tomorrow is not the criterion. In the case of sale of land and building, so, the department has come up with a concept called deemed consideration under section 50C, because it's of common knowledge that in the case of sale of immobile properties, undervaluation is rampant. Therefore, to club this malpractice, what the law says is that in the case of, again, let me say it is land and building, the sale consideration is either the actual sale consideration as per the transfer deed or the guidance value fixed by the revenue authorities for stamp duty purpose, whichever is higher. That is, say I'm selling a piece of land at 1,000 rupees per square feet, but the guidance value fixed by the revenue authorities, say the value in that area is say 3,000 rupees per square feet. Then for the purpose of working out of capital gains, my deemed consideration, that is consideration, is treated as if I have received 3,000 rupees per square feet. Whether I actually receive only 1,000 or 3,000, it is immaterial. So minimum sale price should be this guidance value. But however, from 2018 onwards, a safe harbor has been provided to the extent of 5%. That is, suppose guidance value is 105 rupees per square foot and I declare it to be only 100 rupees in my transfer deed, but this difference is ignored. That means if the difference is up to 5%, such a difference is ignored, and whatever the declared value is there, that will be accepted as the sale consideration. Otherwise, in all other cases, it is the guidance value that should be the minimum value of consideration. It may so happen that I enter into a sale agreement today and sell or register the sale deed after say 6 months. In this meantime, the government comes up with a new guidelines for the guidance value and enhances the guidance value. Then for the purpose of working out capital gain, what is the value that I should take? Because capital gain is based on actual transfer and not on the basis of agreement. So which is the value that I have to consider? That is, as on the date of agreement or date of the registration. For this purpose, Income Tax Act says that if the consideration was received by prescribed modes. Now, what are these prescribed modes? Like say your account pay check, account pay demand draft, or electronic transfer, etc. Only these modes. then it is a date of, the guidance value as on the date of agreement that has to be considered, and not the guidance value as on the date of registration, which would be a higher figure. But let me remind you again, this is applicable only if the consideration is received by the prescribed modes like account pay check, account pay DD, electronic transfer, etc. If suppose we receive cash, then this clause is not applicable. Then the question is whether this guidance value would be sacrosanct. Now, Income Tax Act provides that in case guidance value has been fixed and the assessee does not contest this guidance value, the taxpayer accepts the guidance value but disputes it before the assessing officer. Now, how can this happen? Because guidance value is always fixed with reference to an area and not with reference to any particular property. Suppose there's a piece of land and guidance in a posh area, so guidance value would obviously be very high, but there is an encroachment on this land, so value for this particular piece of land will not be high as the guidance value is. So when the taxpayer tries to sell this, the seller would obviously ask for a lesser rate and he will not agree for the value that is fixed for stamp duty purposes. So in this case, assessee does not dispute the valuation before the revenue authorities, but he can raise a dispute before the assessing officer. In such a circumstance, assessing officer has to make a reference to the valuation officer of the department, and the taxpayer can represent before the valuation officer about the difficulties in the valuation going by the guidance value, and based on the valuation fixed by the valuation officer, capital gain would be computed. Thank you, friends. That's what I had in this video. In case you have any queries, please leave the same on the commentary box. Thank you.